We are delighted to round out another strong year for our unit holders. The Montaka Global Long-Only Equities Fund, for example, has now delivered returns of 50% per year for the last 2 years, net of fees. It's now nearly 5 years since we substantially enhanced Montaka's investment formula and capabilities, and these improvements have pleasingly manifested in this year's strong performance. So our investing formula is to identify high probability, advantaged, long-term winning businesses that are well positioned to benefit from large structural transformations. And we want to own these businesses only while they remain undervalued. So this formula is actually an evolution from where we started a decade ago. Historically, we were more traditional value investors, focusing on valuing cash flows that we could forecast with some degree of confidence and buying these for less than their intrinsic value. Today, while we retain our discipline around valuation and continue to remain mindful of risks, we've narrowed our focus only to advantage businesses within large structural transformations. Now, Montaka's investing formula doesn't only deal with what to own and why, it is clear about how we own these businesses, and that is how we design and manage Montaka's portfolio. So 2025 will mark the 5-year anniversary of Montaka's evolved portfolio construction philosophy, when we moved to the concept of owning relatively few, outsized, long duration investments. And based on our performance, this formula has greatly enhanced Montaka's investment capability in our view. When we repositioned 5 years ago, we did it knowing that when we made big capital allocations to our best ideas and then nurtured them with extreme patience, we had a much higher probability of delivering outstanding long-term returns. And our investing formula is backed by empirical and academic evidence, which shows that only highly concentrated and patient investment strategies tend to substantially outperform over the longer term. So our top 10 investee companies account for 75% of Montaka's total portfolio, and our annual portfolio turnover on average is running at about 25%, which means like a 4-year average holding period. This combination is in stark contrast to the average of the US large cap mutual funds, for example, which have only about a third of their portfolios allocated to their top 10 and an average holding period of only about 20 months. And you can see this in the chart, along with the significant extent to which Montaka has repositioned from nearly 5 years ago. Now, one of our most important learnings over the last decade is that long-term investing success requires more than just the right investing formula. It also requires the right conditions for that formula to be executed. So ultimately, long-term investment returns are the result of 4 ingredients. So number 1, the formula, which we just described. Number 2, the culture, which is required to execute the formula. Number 3 is the structure, which is required to enable the culture. And then number 4, of course, is luck, which remains out of our control, unfortunately. But arguably, this reduces in significance over the long term. Over the last 5 years, enabled by the extraordinary patience of our unit holders, Montaka has substantially strengthened these ingredients. And our strengthening results over this period reflect these changes. So it is within this context that Montaka's impending tie-up with MFF is so important. When we combine with MFF, it will further strengthen these ingredients we just described. Not only will Montaka gain access to greater resources and experience, but the new ownership structure will provide the permanence Montaka needs to make and nurture the large, long-duration investments that are key to driving superior long-term compounding for our unit holders. Said another way, Montaka's investment capability should continue to grow stronger under these new arrangements. Montaka's long-term success will ultimately stem from the identification and ownership of businesses with advantages that allow them to grow reliably for longer durations than the market expects. So what's interesting about 2025 specifically, and we suspect quite underappreciated by many, is that in addition to our favoured structural trends continuing, there are at least 4 cyclical upswings that are relevant to Montaka's portfolio that we see emerging. With a collective $1.7 trillion in assets under management, and with access to the best talent, capital, and deals all around the world, Blackstone and KKR, two of Montaka's largest holdings, are highly advantaged alternative asset managers. They are well positioned to benefit from a number of structural tailwinds, but in 2025 specifically, we see them also benefiting from an upswing in monetizations of historical investments, which have been running at a trough. So monetizations are simply when investments that have been made in the past are finally converted to cash, typically via a sale. So in October last year, KKR highlighted that monetizations of historical investments had recently ticked up, and management sees these accelerating in 2025 across the industry, and this is a view shared by Goldman Sachs and others. So monetizations will turbocharge Blackstone and KKR as they earn significant performance fees, and monetizations will also give them an opportunity for what's called capital recycling, which is basically raising this capital back for new funds. This has also been running at a 2-year trough. Digital transformations and AI deployment are also set to enter a cyclical upswing, which will benefit a number of our advantage companies that we own. So a full 80 to 85% of enterprise workloads still reside on premise, but most will ultimately move to public clouds over time, benefiting the hyperscale cloud providers that we own. And separately, given all the hype, it's hard to fathom that large-scale deployments of AI-based enterprise applications have barely even started. So 2025 will be the first year that we really start to see meaningful deployments and adoption of these kinds of applications. So Salesforce is a prime example of an enterprise software provider emerging into a new upswing. Its revenue growth is at a cyclical low. Indeed, it's just at 8% per annum, as reported in the most recent quarter. And this rate of revenue growth really has never been lower. But in 2025, not only will price increases that were announced a couple of years ago boost Salesforce's revenue growth, but this year will also mark the early stages of adoption of the company's new Agentforce. This is a new platform that lets businesses build and deploy their own custom AI agents to automate tasks, improve efficiencies, and enhance customer experiences. So we think Agentforce will multiply a number of the company's existing business advantages, particularly Salesforce's mission-critical position within an enormous enterprise customer base. Agentforce should substantially increase Salesforce's total addressable market and long-term value, in our view. ServiceNow is another mission-critical enterprise software platform that is also rolling out new AI-enabled features to significantly boost customer productivity. And so like Salesforce, we believe 2025 will be a pivotal year for the adoption of these new features. The broader global investing environment will also likely improve cyclically in 2025. The global monetary tightening cycle has now peaked, and we are in the early days of an easing cycle, including in the US, the Eurozone, and China, which collectively represent about 60% of global GDP, and we see this easing continuing through 2025 and beyond. So while there is no shortage of political upheaval all around the world, in 2025 we'll actually exit a trough of political dysfunction in the world's largest economy, which is of course the US, and to which a majority of Montaka's portfolio is exposed. So political dysfunction stems from the different legislative bodies being controlled by different political parties that can't agree on anything. Of course, the surprise clean sweep in the November general election that happened recently means that Republicans will now control the White House, the House of Representatives, and the Senate, and they will be able to pass new laws with relative ease. So we expect to see a lot of new government policies enacted, including along the dimensions of tax reduction and deregulation, at least until the midterm elections in 2 years' time. So these collective business conditions will benefit the shareholders of many businesses, but including luxury giant LVMH, given its exposure to Chinese consumers, as well as S&P Global, for example, whose credit ratings business and market intelligence business will benefit from improving business conditions in the US. We also expect a recovery in the all-important US housing market to accelerate in 2025. Now, it's worth highlighting that high mortgage rates combined with recession fears over recent years resulted in a complete collapse of existing home sales. So even today, they remain at the lows of the 2008 GFC, as you can see in the chart showing. But under the hood, households are actually far better off than they were. So indeed, most homeowners have large equity cushions in their home in the US. So mortgage debt in the US as a percentage of GDP is 45%, thereabouts, down from a peak of 73% that we saw during the GFC. So a recovery in the US housing market would be really helpful for US consumption, as well as the health of the broader economy. And it would be particularly potent for big box specialist hard surface flooring retailer, Floor & Decor, which is a top 10 holding in Montaka's portfolio. So as home sales increase, so too does demand for home renovation inputs, including hard surface flooring. While the bulk of Montaka's portfolio exposures continued to remain relatively stable over the December quarter, we did undertake some modest hands-on portfolio management in the tail end of the portfolio. So we exited 3 of Montaka's smallest portfolio names, Kyndryl Holdings at a profit, United Health Group at a profit, and Alibaba at a loss. And while we see long-term upside in all of these names going forward, we actually see more upside elsewhere. And so we reallocated these proceeds to a couple of areas. Number 1, to scale up Montaka's investment in Alphabet on increasing probabilities that its advantages in Google search are actually strengthening despite new competition, not to mention the group's numerous growth options that are also increasing in probability, from YouTube to Waymo and even quantum computing. And then number 2, we established an initial outlier position in database software provider MongoDB. Now, by way of reminder, we view outliers as option-like in that their upside potential is very, very large, but the probability is far less certain. So on this basis, we deliberately restrict Montaka's aggregate portfolio allocation to outliers, currently stands at less than 7%. The remaining 93% of Montaka's portfolio is allocated to businesses we classify as compounders. So in the chart showing, you can see the composition of Montaka's top 10 investee companies at year end. Consistent with our investment philosophy, all these are businesses that have strong and strengthening advantages over their competition. They're all positioned within favourable structural transformations and tailwinds. And even despite strong recent stock price performance, we think they remain materially undervalued. So on behalf of the entire Montaka team, we thank you for your partnership and patience, which has allowed Montaka to evolve substantially. Without this, our recent strong performance would not have been possible, and our future would not look nearly as prospective. So it has been, and it continues to be, our true privilege to partner with you on this investment journey that we are all on together.